Hey there, broadcaster from GreatOptionTradingStrategies.com. If you're new or relatively new to option trading, whether you're in your 20s and just starting to build your financial future, or you're in your 50s or 60s and planning for retirement, this could be the most important video you watch this year. If you struggle at all with your trades, if you're losing money, if you make big gains only to give it all back on your next trade, if you get stressed when a trade goes against you, if you find yourself silently or not so silently railing against market makers and blatant market manipulators, I have a very simple message for you. Stop buying options. Period. It's like cigarettes. If you smoke, stop. If you don't smoke, don't start. And if you're brand new to options and the world of options seems exciting but also at times overwhelming and confusing, which most newer traders do feel, so you're definitely not alone, let me help you cut through the noise by having you download my free report, Options Are Easy. Stop stressing and learn what options can do for you. This user-friendly 10-page guide breaks down the nuts and bolts of option trading and will have you up to speed in no time at all. There are basically two types of options, calls and puts, and there are only two things you can do with them: buy them or sell them. That's it. Those are the building blocks that everything else in the entire option trading world is built upon. And having a simple but solid foundation and some basic clarity is the key to your future success. You can download the free guide in the pinned comment below or check out the link to the full downloadable library page on the Great Option Trading Strategies website in the description section. So in this video, we're going to look at why it's so damn hard to be a successful option trader over the long term when you buy options. We're also going to look at how to actually stack the deck seriously in your favor when you become an option seller and then legally cheat when you need to. And then the most important mindset you need to have for true long-term trading success. Part 1, the big problem with buying options, having to be right. The main problem with buying options isn't one problem. It's actually three problems all rolled up into one. Think of it in terms of a heist where you have to crack not just one, not just two, but three locks. In order to make money on a long option position, whether you're buying calls on a stock you think will trade higher or buying puts on a stock you think will trade lower, you've got your job cut out for you. That's because you have to be right on three things or you're going to lose. You have to be right on direction, you have to be right on magnitude, and you have to be right on timing. Now that's a pretty tall order. With apologies to the late Meatloaf, 2 out of 3 may not be bad, but in this case, 2 out of 3 ain't good enough. So you buy calls expecting a stock to make a substantial move higher. The stock could soar, but if it does so the week after your option expires, you lose. The stock could move in your direction, but if it's not enough to cover the premium you paid and get past your break-even point, you lose. The stock could even hit your target, but if it takes its sweet time and grinds sideways for weeks, letting Theta Decay eat away at your options value, guess what? You lose. Now, I'm not making straw man arguments here. There are ways you can structure your long option trades to make being right times 3 less of a long shot, and to make the consequences of not being right on all three factors less severe. But at the end of the day, this is an uphill battle, and those who are successful put a ton of work and discipline into their trades and have an unusual constitution where they're comfortable taking losses on a majority of their trades in anticipation of generating much larger gains on a smaller number of trades. In contrast, selling options, when you learn to truly recognize and then exploit the structural advantages of short options, it's just the opposite. You just have to be right about one thing, what a stock won't do within a certain time frame, and that's a hell of a lot easier. And actually, that's not even true. Yes, it's better to be right about what a stock won't do within a certain time period because it's simpler and it leads to higher annualized returns, but it's not actually necessary. Option selling really can become heads you win, tails Mr. Market loses. In fact, I'm typically wrong on 20 to 30% of the trades I officially trade inside the Leveraged Investing Club. But at the same time, it's rare that we ever book a loss inside the club. Case in point, and I've added a link to a PDF detailing all of these trades. But in 2025, we closed 46 club trades and all of them were winners. Only 4 of those trades resulted in single-digit annualized returns. The other 42 produced double-digit and triple-digit annualized returns. And as of last Friday, January 16, 2026, we've already closed out and booked profits on 3 more trades. And guess what? One of those was a put-selling trade where I was totally wrong and the stock sold off on us. Also, just to be clear real quick, these are annualized returns, not total ROI returns. I use the annualized metric extensively because I feel it's the most accurate way to gauge the true efficiency of your trading. It's basically a money speedometer that tells you how fast your money is making more of itself. And unlike an actual vehicle, there's no penalties for speeding. Now, I'm not going to do a deep dive on put selling or covered call for income trade repair here, but I've got an entire playlist dedicated to option selling trade repair, and I've added links in the description to a number of previous videos that documents just how remarkably effective a systematic trade repair approach can be for sellers of options, even on trades that really go the wrong way on you. Part 2, option buyers on the wrong side of time value and paying rent every day. So let's talk about the second problem, time value, theta decay, the silent thief. When you buy options, you're on the wrong side of all that. Every day there's a slow leak in your position, like a leak in a balloon. You might not notice it at first, but it's there, and at some point it's going to be very obvious. And the closer you get to expiration, the faster an option loses time value. So that means you can be right about direction, but as we've already seen, if the expected move isn't strong enough, quick enough, you're still on the losing end of another trade. It means you can buy a call and watch the stock go up, and your option doesn't go up the way you think it should because time value is melting. It means you're entering trades where your enemy is time itself. As an option seller, however, the tick, tick, tick of time passing is a chief ally and a close friend, or a loyal and diligent employee working silently in the background. As an option seller, you get paid to bet that a stock won't make a certain move in whatever direction you prefer within a certain time frame, and then you sit back and wait. If you're right, which you should be most of the time once you learn to identify quality trade setups and then adhere to some basic disciplined trade entry and management principles, well, making money doesn't get any easier than that. I posted another link in the description, my video that shows you my 3 favorite option selling setups and strategies. But here's the deal. You get to sell the air in the balloon with the leak. And if you're wrong and Mr. Market manages to huff and puff and temporarily blow a lot more air into the balloon, that's okay too, because you'll be able to continue selling that air too. Okay, I feel that this is starting to border on being a bit too simplistic of an analogy. The bottom line is that being able to sell future time value on a position, not just the time value from the initial entry, is a huge structural advantage and the reason why option selling trade repair is even possible in the first place. Again, this video is not a deep dive on trade repair. Please see the links to those videos in the description section. And I'm talking about more than generic advice like just keep rolling a position and hope it comes back for you and a trade gets repaired out of luck or randomness. The point is, if you're new or relatively new to options, the last thing you need is a strategy where the default setting is a loss unless everything goes your way. You want a strategy where the default setting is time is on your side, baby. Part 3, professional gambler or crooked insurance operator. Okay, so let's take a step back and look at things from a bigger picture view. When you have to be right or else you're going to lose money, that's not investing and that's not a business. That's gambling. Buying options forces you into a high-stakes poker game with Mr. Market. It may be exciting, it may be an ego rush, you may do things to lessen the risk, and who knows, you might actually have insane analytical skills and big brass balls and really be good at the game. But at the end of the day, you're playing poker against the best poker player there is, Mr. Market. And because you have to be right about so many things, it's high-stakes poker. You can have a good, even great hand and still lose. Selling options, by contrast, is a completely different model and mindset, and in my experience, so much easier to succeed at over a lifetime. It's not gambling, unless you're doing it wrong. And this is where I go back to the insurance company from hell model, because option selling truly can be structured into a consistently profitable business operation. Inside the Leveraged Investing Club, when we sell options, we're insuring against events that we feel are unlikely to occur in the near term, such as such and such stock trading below a certain level, or in some instances, above a certain level. And in the event that that actually happens, and this isn't something remotely possible with real-world insurance companies, we can completely renegotiate and restructure the policy in our favor, and also continue to collect more premium. Heads we win, tails Mr. Market loses. So what's the catch? There are basically 2. One's mathematical and one's psychological. In terms of math, you're obviously better off when everything goes according to plan with the trade because, except in rare or weird circumstances, your rate of profitability will be higher when there aren't any complications with the trade, when there's no need to roll or adjust or repair. But when a trade doesn't go according to plan and repairs are necessary, while we fully expect to walk away at the end of the day with more money than we started with, our margins, as it were, or the rate of profitability, will be lower. But really wrap your head around the mindset that a bad trade doesn't mean a loss of capital. It just means smaller gains. And smaller, not small. For example, of the trades we closed inside the Leveraged Investing Club in 2026 that had to be repaired, the average final annualized ROI on those trades was 13.11%, and the median final annualized ROI was 12.41%. Now, there was one trade campaign on O, Realty Income, that generated 8.33% annualized over 193 days, but that wasn't a true repair campaign as much as an experiment where I toyed around with trying to collect more from selling puts on the stock versus simply owning the stock and collecting the dividends. It turns out that yes, I could do that, but it also turned out not to be a particularly efficient use of capital as there were much better opportunities elsewhere. Now, the other catch is psychological. I said earlier that to be a successful buyer of options, you need balls of brass and a gambler's mindset. That was just a colorful way of saying that you need to have a personality that's okay with losses, plural, and even big losses, and an unshakable confidence that you know what you're doing and that you're going to land some very large fish at some point. Now, when you sell options the way we do inside the Leveraged Investing Club, you also need to have a certain psychological makeup. You need to be okay with a certain level of ambiguity, as in not knowing how long you'll need to keep a trade in repair mode open or what the final returns will be. Now, once you understand the math part of our very specific and very customized repair campaigns process, and once you've experienced 2 or 3 serious trade repairs yourself, the psychology aspect should take care of itself, and you learn to trust the process. Not because you're naive or gullible, but because you understand the process and experience it firsthand. Okay, to wrap up, for any traders out there who are adept at being a buyer or net buyer of options and you've had long-term success, congratulations. I salute you, your skill set, and your mental fortitude because you've done what most people can't do and won't do. But for everyone else who struggles to consistently make money trading options in the stock market, you bank some big wins, you bank some big losses, you basically tread water, or worse, you blow a hole in the side of your portfolio at some point. It's not you. It's the game itself. And your assumption that buying options is the only way to make outsized gains in the stock market. But there is another choice, another paradigm, one where you have a stack of advantages and the ability to restructure outcomes you don't like. So if you're tired of losing, if you're tired of being pushed around by Mr. Market, and he's after more than your lunch money, I can promise you that, I can help you turn the tables on him by becoming the most adept option seller you can possibly become. The best way to start that process is to download any of the free resources from the description section or sign up for my free daily option tips and insights newsletter in the pinned comment below. And I don't spam, I promise. And of course, subscribe to the channel if you haven't done so already. I've got a ton of video ideas in the pipeline and I'm trying to add 2 or more per week. Okay, until next time.